first problem is doing some actual adjusting journal entries. The first one's depreciation, and in this example, we don't have to compute it, they're already telling us what the amount of depreciation is. I think we'll have a couple problems later where we'll compute the depreciation, but here they just say depreciation for the current year includes equipment 2100. So we know the account that we will debit is always the one that says depreciation expense, equipment 2100. And then the account that we credit is always the one that's called accumulated depreciation for the equipment. And then at the bottom we can put to record depreciation on equipment. Okay, each Monday, Betterton pays employees for the previous week's work. The amount of weekly payroll is $1,400 for a 7-day work week, Monday to Sunday. This week, December 31st, falls on a Thursday. For some of these problems that involve math, I think I'm going to try putting it on the screen in Excel, because it seems like with the chalkboard, it's hard for people to see it on both sides of the room, regardless of where I try to do it. So I'm going to try doing this in Excel. So the weekly payroll is $1,400, and that's for 7 days a week. So the amount of daily payroll is $200. Now, the end of the year falls on a Thursday, December 31st. The payroll starts on Monday. So Monday, Tuesday, Wednesday, Thursday. That's 4 days of payroll that we have to accrue for through the end of the year or the end of the month, whichever you want to think of it as. So 4 days times $200 a day is $800. We're not concerned about the other 3 days of the 7-day work week because those will fall in January, and we're only concerned about through December. So we will debit salaries expense, $800. We will credit salaries payable, $800. And at the bottom, to accrue salaries expense. So does everybody understand why we do that for 800 then? Okay.
Yes.
Okay, here's an office supplies problem where, as I was mentioning during the lecture, we have to usually figure out what it is that we have to include in our adjusting journal entry. So I have a T account here that we'll call OS for office supplies. Now here they say the beginning balance in office supplies is $2,300. And during the year, they purchased office supplies of $3,000. So that's going to be another debit to office supplies. And on December 31st, the office supplies on hand totaled $1,000. So that means the ending balance in office supplies is a debit balance of $1,000. So we have to figure out how much they've used in office supplies, which is going to be the amount that we credit to the office supplies account. So our combined debits here are 5,300. And we wanna end up with a balance in the account of 1,000. So how much do we have to credit the account for?
4,300.
Right. This needs to be a credit of 4,300. That's the amount that we've used up of office supplies. So now for our journal entry, we will debit, supplies expense, 4,300. And we will credit office supplies, 4,300. And at the bottom, to record office supplies used. Okay, then, next, Betterton prepaid 2 full years insurance on July 1st of the current year for $6,000. Record insurance expense for the year ended, December 31st. So, the total amount was 6,000. Since that was prepaid, 6 months have gone by,
Thank you.
and the policy was for a total of 24 months. So the part that's used up would be $1,500. So, insurance expense would be the account we debit, $1,500. And we will credit prepaid insurance to reduce the amount that's shown as an asset on the balance sheet, 1,500. And at the bottom, we put to, record insurance expense. Then, this is easy. Betterton had earned $2,800 of unearned revenue, so they're telling us really what to journalize there. So, we're taking it out of the liability account, so we debit unearned, revenue, 2,800. And then we put it into, service revenue with a credit, 2,800. And at the bottom, we put, to record service revenue that was collected in advance. And then, Betterton had incurred but not recorded $200 of interest expense on a note payable. The interest will not be paid until February 28th. So we would debit interest expense, $200. We would credit interest payable, $200. And at the bottom, we put to accrue interest expense. Okay, then Betterton billed customers $3,000 for welding services performed. This is really no different than what we would have done in chapter 2. So we know that we'll have to debit accounts receivable, 3,000, and we will credit service revenue, 3,000. And at the bottom, we put, to accrue service revenue. Okay. On October 1st, Orlando Gold Exchange paid cash of $57,600 for computers that are expected to remain useful for 3 years. At the end of 3 years, the value of the computers is expected to be 0. we're supposed to calculate the amount of depreciation for the month of October using the straight line method. So, first of all, I guess they want us to put the formula for it. So it would be, cost minus residual value divided by useful life divided by 12 months. So the cost is 57,600. Residual value is 0. Useful life is 3 years. So over here in Excel, I'll do this 57,600 divided by 3 divided by 12. Oh, forgot to put the equal sign. So that would be $1,600 is our monthly depreciation. Okay, then record the adjusting entry for the depreciation on October 31st. So we know it will say depreciation expense, computer equipment, 1,600. And then accumulated depreciation, computer equipment credit, 1,600. And at the bottom to record depreciation on computer equipment. And then they want us to post the purchase and the depreciation to the T accounts. So computer equipment T account is where we would post the purchase. So on October 1st, we want to put a debit of 57,600, and then we'll put a balance.
You mind expanding that page just a little bit so I can just.
Okay.
Picture? Yeah. Thank you.
And then for accumulated depreciation, our journal entry had a credit of 1,600. And that was on October 31st. So the balance is a $1,600 credit as well, or 1,600. And then depreciation equipment, that would be a debit of 1,600 on October 31st and a balance debit of 1,600. And then calculate the equipment's book value. So the first label that we should put there would say computer equipment for 57,600, then less accumulated depreciation computer equipment 1,600, and then book value of computer equipment would be 56,000. Okay, you can help me with answering some of these multiple choice questions now. And this one's really tricky. Under the revenue recognition principle, a good or service is considered transferred when
The customer obtains control of the good or service.
I think that's right. Yeah. Okay, which of the following entries would be made, there's a lot of stuff we could have gone through in chapter 3 with the revenue recognition principle, but we didn't do all that. Which of the following entries would be made because of the matching principle?
C.
Yeah,
Okay.
I think it is C. So, to think that through, it would have to be an expense that you had not entered yet or had to be put into the appropriate period, and you would do that by debiting an expense account and crediting a payable account. So C would be the correct way of doing that. Remember that adjusting entries never involve a cash account, so you could rule out those two possibilities to begin with, and then it wouldn't really make sense for there to be an expense account and a revenue account involved. Adjusting journal entries always involve an income statement account and a balance sheet account, but never the cash account, so the only thing here that could possibly be an adjusting journal entry is the one that we selected there, C. Okay, which of the following is not a type of adjusting entry?
B.
Yeah, unearned expenses. There's no such thing. There's unearned revenue, but there's not unearned expenses. During the accounting period, office supplies were purchased on account for $3,500. A physical count on the last day of the accounting period shows 900 of office supplies on hand. Supplies expense for the accounting period is 3,300. What is the beginning balance of office supplies? So let me split my screen here again. So the purchases of office supplies were 3,500. Physical count on the last day were 900, so that would be our ending balance. Supplies expense, which would be a credit, so that's 3,300. I'll move this 3,500 purchases down a line. So what we want to know is what was our beginning balance. So the changes that we see here are a net addition of $200. So we added 3,500, subtracted 3,300, so that's a net increase of 200, and we ended up with a balance of 900. So what would be the beginning balance then?
700.
Right, it would have to be 700 here that we would be looking for as our beginning balance. So it would be the answer. Okay, this company bought computer equipment for $20,000. Zero residual value, 4-year useful life. They use the straight line method. We're supposed to calculate depreciation expense for January 1st through September 30th. I don't know why we're calculating it there for the 9-month period, but we are. So $20,000 divided by 4 years, and then times 9 months divided by 12 months. So for 9/12 of the year. So it would be $3,750 for the 9-month period. Okay, here's another one. They bought communications equipment for $10,800. The equipment has an estimated useful life of 5 years, 0 residual value. They use straight line method. As of June 30th of the current year, the balance in the accumulated depreciation account for the equipment is so it would be as a 5-year life, but only half of a year has gone by. So the accumulated depreciation would be 1/10 of what they bought it for. So it would be $1,080. Okay, another one, they purchased a machine for $16,000 2 years ago. The machine has no residual value, estimated useful life of 10 years. They use straight line depreciation, calculate the current book value of the machine. So we have to subtract 2 years of depreciation from the cost. So cost is $16,000. So first year's depreciation we would subtract would be $1,600. Second year's depreciation we would subtract would be another $1,600. So at the end of 2 years, the book value would be $12,800. Okay, this company sells tickets in advance for its weekly productions and records the proceeds as unearned revenue. This one's a little hard to follow what they're talking about, but at the end of each month, the company makes an adjusting entry to account for the tickets used during the month. On March 1st, the unearned revenue account had a credit balance of $1,200, representing 300 tickets at $40 each. During March, Mercury sold an additional $600 tickets at $40 each, and 550 tickets were used during the month. What is the balance in unearned revenue at the end of March? So, in March, there were more tickets sold than used. So we started with $12,000 in unearned revenue, and then what we would add to unearned revenue during March would be 50 tickets at $40 each, because we sold 600 tickets and 550 of those are used. So we add 50 tickets to our unearned revenue. 50 tickets times $40. So at the end of March, our unearned revenue would be $1,400, and that would have to be a credit balance because that's a liability. An expense that has been incurred but not yet paid is called a what?
A deferred expense.
No, that's if it's been paid but not yet incurred. Yeah, it's an accrued expense. Okay, Global Enterprises signed a 1-year $42,000 note payable at 8% interest on April 1st. They only adjust its accounts once a year at year end. How much interest expense was accrued on December 31st, 2025? So, remember the formula for, interest expense. We would take the $42,000 principal times 8% times, it's been outstanding for 9 months, April through December, so times 9/12. So that would be $2,520 of interest. Okay, on January 1st, the accounts receivable of Martha Inc. had a debit balance of $200,000. During January, the company provided services on account of $400,000. The company collected $230,000 from its customers in January. What was the ending balance in accounts receivable? So we could look at a T account again for this. So we'll call this T account AR for accounts receivable. So beginning balance debit of 200,000, and then we would add to it 400,000, and then the collections, which would be a credit, would be 230,000. So the ending balance, 600,000 minus 230,000, so that would be 370,000 debit. Oh, okay, this one's a little complicated too. They tell what, this is a social event planning service, they tell what the unadjusted balances are in various accounts. And then it says during December, the company worked with a new client and provided event planning services for an upcoming event. It will receive the full amount of $2,550 when the event is completed in January. At the end of December, it performed 1/3 of the services covered by the contract. The company made the accrual adjustments. The balance of service revenue, as shown on the adjusted trial balance, should be what? So before the adjustment, if you read the problem, what they had in service revenue was $16,000. So now for this adjustment, we would take $2,550 divided by 3, because they will have performed 1/3 of these services during December. And so we would have service revenue of $16,850, and service revenue would, by its nature, be a credit. Revenue account is a credit, so we have a credit balance of $16,850. Okay, that was it.